Who was Richard Wyckoff? He was a Wall Street pioneer from the early 20th century. While others simply studied price charts, Wyckoff studied the big players. He noticed a recurring theme. Everyday retail traders were constantly getting fleeced by large institutions. Retail traders traded on emotion, hope, and fear, while the institutions traded on cold, calculated strategy. So, he developed a system to help the little guys spot the footprints of institutional money, allowing them to trade with the giants instead of getting trampled by them. The core of his theory is a concept called the composite man. Instead of trying to understand the motives of millions of random traders, Wyckoff said you should imagine that one single entity controls the entire market. This composite man represents all institutional smart money. He has virtually unlimited capital, incredible patience, and a team of experts at his disposal. His only goal is to buy low and sell high. If you can understand his tactics, you can predict market moves. Wyckoff's method relies on 3 unbreakable laws. Number 1, the law of supply and demand. This is the absolute ruler of the market. If demand is higher, prices rise. If supply is higher, prices fall. If they are equal, the market just chops sideways. It sounds simple, but watching how price really reacts at key levels tells you exactly who is in control. Number 2, the law of cause and effect. Big trends do not just happen out of nowhere. Think of it like winding up a jack-in-the-box. A massive, sideways trading range builds the cause, winding the spring tighter and tighter. The explosive breakout that follows is the effect. The longer the market chops sideways, the bigger the eventual move will be. Number 3, the law of effort versus result. This compares trading volume to price movement. Volume is the effort, and price change is the result. If a stock has massive volume, meaning huge effort, but the price barely moves upward, it means big sellers are quietly absorbing all the buyers. When effort doesn't match the result, a reversal is imminent. Wyckoff observed that markets move in a continuous, 4-stage cycle. First is accumulation. The composite man is quietly buying after a long downtrend. He is systematically absorbing shares from panicked retail sellers, but doing it slowly so he does not drive the price up. Second is markup. Accumulation is done. The supply of shares is locked up in the composite man's vault. With no supply left, even a little demand rapidly shoots the price upward. Third is distribution. The price hits the target, and the composite man quietly sells his massive position. He offloads his shares to late, FOMO-driven retail buyers who think the price will go up forever. Fourth is markdown. He has dumped his shares, the artificial support is gone, the buyers vanish, and the price aggressively tanks, starting the cycle all over again. Let's look closer at accumulation, which happens in 5 phases. Phase A stops the downtrend with massive panic selling, followed by an automatic bounce. Phase B is the longest period. The market chops sideways, boring retail traders to death or stopping them out, while the composite man quietly buys. Phase C is the ultimate trap. Wyckoff called this the spring. The price fakes a drop below support to trigger retail stop losses and trick people into selling short. The composite man scoops up this panic liquidity at a discount and the price rapidly recovers. Phase D is the transition, where demand finally takes the wheel and the price inches upward. Finally, Phase E is the breakout, and the new uptrend officially begins. Distribution is the sinister mirror image, the composite man's final act of deception. It starts in Phase A as the uptrend hits a wall of profit-taking, leading to the Phase B mirage, where price is kept artificially high to lure in hopeful buyers. Then comes the kill shot, Phase C's upthrust. This is a violent fake breakout to new highs that baits greedy retail traders into providing the liquidity the big players need to dump their final shares. Once the trap is set, support snaps like glass in Phase D, and by Phase E, the floor vanishes entirely, triggering a devastating freefall into a new downtrend. Now, a grounded reality check. Wyckoff's theory is brilliant, but real-world charts are messy. You will rarely see a textbook spring that looks perfectly clean. Sometimes a phase is skipped, or a trading range slants diagonally. The real value is not in memorizing jargon like automatic rally or last point of support. It is in understanding the raw psychology of supply, demand, and liquidity traps. To use this method, you must watch volume closely, because volume is the one thing the composite man cannot hide. It takes significant screen time, immense patience and practice to identify these moves in real time, rather than just spotting them in hindsight. Trade what you see, not what you want to see.